What's up, guys? Welcome to the Fit to Flourish podcast. It's your boy, Mr. Fit to Flourish. And I was going to make this a pretty complicated explanation, but I was like, no, this is the Fit to Flourish podcast. We teach trading from A to Z, and we make it easy. So let me make this really easy for you. So let's get right into it. I'm going to share my screen here, and we're going to talk about gaps and fair value gaps, okay? So let's get right into gaps. So when we're looking at the charts, gaps fill about 90% of the time, okay? So gaps fill 90% of the time, and they fill sooner than later. It could be today, it could be tomorrow, it could be the next week. But when we're trading, especially on the 5 minute time frame, and we're doing day trades, it'll fill pretty quickly. It acts as a vacuum for price action. So since prices weren't traded in there, we need orders to get fulfilled in that gap. And you'll see later on why, like, price gravitates to those fills because every fill must get filled. So if people were trying to sell in those areas and they weren't able to sell before, they're going to be able to sell once price moves back to that area, and vice versa for buying. So price must trade at all levels. So gap fills. So this is an example of a gap fill. So this is an RTH gap, so a regular trading hours gap, which basically means this day right here was the 5 minute time frame from the previous day. And then we opened down at this level here. We tried to sell off. We held on to support, bounced to the upside. And as you can see, price was attracted to fill that gap. We filled that gap and then ended up selling back off. So once the gap is fulfilled, price action is free to do whatever it wants to do. But typically we get gravitated, we get a pull as a magnet to that area. So gaps get filled quite a bit of the time. So gaps occur a lot at the open of market, and news usually causes stocks to open up trading higher or lower. So in this case, the stock opened lower than it ended trading. Ended trading yesterday. Sorry. Gaps act as magnets, and price action goes in the direction of the beginning of the gap, trying to close it. Now, one concept that was made popular by ICT, this trader guy on YouTube. So he made a concept called fair value gaps, FVGs. He made it very popular. And all this is order imbalance. So remember in the series we talked about a couple videos ago, we talked about order imbalance, and that's when price moves up too quickly. When price moves up too quickly, we don't get buy and sells balanced out. So therefore, we create a gap in price. We create order imbalance. We always need, for consumers and sellers, we need buyers and sellers to balance out. So whenever we get too much buying, then we don't have enough selling. We need to balance out. So that's why we get these massive gaps, and typically it gets filled because we need to balance. Okay, life is all about balance. So fair value gaps are basically the difference between the current value of an asset or currency and its fair value. And this is due to inefficiency or imbalance in the market. So fair value gaps, you'll hear it called a lot now, but it's actually called order imbalance. Okay. So on the left-hand side, we see a bullish fair value gap. And on the right-hand side, we see a bearish fair value gap. Okay. Bullish because green bars, it's going up. Bearish again because it's going down. Fair value gaps are pretty cool tricks to learn in trading. You might wonder sometimes why stocks act a certain way. This pretty much explains everything. It pretty much explains everything. It's basically on a move up or down. You choose any 3 consecutive bars to look at, and it's when the high and the low of the first and the third bar do not overlap. So this is considered a fair value gap in price action, and it needs to price action needs to happen everywhere, basically. So this is considered fair value gap. And when a fair value gap is left behind, expect for that area to get tested. Okay, so here we see, like I said, any 3 bars, so consecutive 3 bars, the high and the low of the first and the third bar, we measure the distance between that. That's the gap. Okay, again, consecutive 1, 2, 3 bars, the low and the high of the first and the third bar in this bearish downtrend, and we get another gap. So some more on fair value gaps. Again, you can see any consecutive 3 bars. It's the high and the low. So low, high, and a down, and then In an uptrend, the high of the first bar, low of the third bar. So the area in between is the gap, and we typically move back down into that gap. And here's some actual examples. This is a pretty small one, but there's a couple different gaps here that you can kind of point out. If you count 1, 2, 3, there's a gap from the low to the high of the first and third bars here. So yeah, that's pretty much it. That's all I had for you today in terms of gaps and fair value gaps. So that's a pretty quick and easy explanation of a fair value gap. When we get gaps, like I said, price needs to be balanced. So we typically get a pull back into those areas at some point in time, typically sooner than later. When we get these pulls, we get price to mitigate, price to equal out, and then we get to move in either direction based on the next market event. Okay. So if you have any questions, feel free to drop them in the comments. It's your boy, Mr. Fit to Flourish. Check out this video right here. If you want to learn a little bit more about charting, go to my trading series. If you want to learn about stocks from A to Z, made easy. I keep it really simple because stocks can only go two ways. They either rip or they dip. Okay. There's no in between. They rip or they dip. And some of these concepts can help you choose the right direction. So thank you so much for tuning in. It's your boy, Mr. Fit to Flourish, and I'm out.